ladies and gentlemen. Welcome to our webinar this evening. Just a little bit as far as on the panelists. Kristen, hopefully you guys can see her. She's been with 16 years with the company. She's in the the marketing division. You know, I've been doing maintenance all day here today. And then we've got Tyler. He heads up as far as business development at Management One, and also does all the listings and sales out of the Orange County area. And then Chrisia, she's been with, I don't know, 10 years or more.
Hello. Something like that. Yeah.
And she does all the sales and listings out of the Inland Empire. So with that said, I'm going to turn it over to Kristen. But before I do, keep in mind, this is being recorded, so you don't have to take notes. You'll be getting a copy of this within about 24 hours. Okay. And then you can make your notes from there. So sit back, enjoy it. Engage with us. This is the type of thing that we like to do with all of our clients. And so we're going to go ahead and get started with Kristen. So Kristen, take it away.
Great. Thank you, Ron. So tonight we are going to kick off our evening with Chrisia giving us an update on the Inland Empire real estate market. Be interested to see how some of the recent changes will affect us. Then we have Tyler talking to us about Orange County. I'm going to talk about combating inflation with real estate. And then Ron's going to bring us 1031 exchange information. And then Tyler's going to give us some interesting updates on the rental market and some legislation that's before us as we speak. So with that being said, Chrisia, welcome.
Hi. Okay. Well, thanks for having me. Yes. So the Inland Empire real estate market, and I know it's been a couple months and we had certain projections, which we spoke about as far as what was going to happen this next year. But it's not panning out to be as low as we anticipated it was going to be. And we never thought it was going to be slow or that it was going to go down, but it is not going, it's not leveling off the way that a lot of us expected. And part of that reason is because we just don't really have the inventory to the demand that we are experiencing. So in this chart, for instance, you can see year over year, we have new listings for last year. We're at 3,744 listings in February. And in this last year, we were down almost 6% year over year in available listings. As of today, I am actually under those numbers. And so we're seeing houses still go up by 10 to 15% in some areas. For instance, we have a property on Rosemont, which we put on the market last Friday. As of Monday, I had approximately 10 offers. That house in Moreno Valley was listed at $615,000. And we are opening escrow today at $665,000. Wow. So, just to let you know how competitive it is, we had 5 offers at $660,000. So, there is an urgency. Now, today we had the Feds meet, which they ended up increasing the rates a bit, and we're going to see that. But we're really not seeing that impact our sales side because we just don't have the demand. So low inventory, house prices are still going up really strong, and rates are definitely going to start going up. We will see where they balance this out in the next few months.
Awesome. So I do have a question. How do you think the interest rate going up is going to affect what you're seeing right now?
I don't think it's going to affect us too much because we just don't have the inventory. We don't have enough available inventory, enough available houses to justify low values going down. So we just really don't have that. We have more and more buyers. I have a client that I put in an offer at $25,000 above asking in Orange Crest. The house was listed at $650. I'm sorry. We went at $675, and the highest bidder right now is at $730. It's crazy. So I do think that the interest rates ideally will allow us to slow down because increases at this rate are just not sustainable. We can't sustain them forever, right? So I think that would be a nice thing to do, to see a little balancing off, but we don't really see too much of an impact just yet.
But the other thing is too, and let me add on to that, is that even if interest rate would go up 2%, it still doesn't matter, because eventually they'll probably come back down and then you can refinance. So not a reason not to buy if the interest rate goes up 1 or 2%. You know, it's just like when years ago when interest rates were 7, 8%, you know, people bought and then they refi them down. So that should not discourage anybody. I think the main thing here is when you see the value of property still skyrocketing, it's a time to maybe really consider, do I want to sell or not? Because there's a lot of juice left in this market. And so by selling now compared to a year from now or 18 months from now, you could easily be leaving a good 50,000 or more on the table. So something to think about.
And just really quickly, we have two different schools of thoughts, right? We have the school of thought that's thinking the market's about to crash, everything's going to come down. I don't want to go in when the market's high. And then we have everybody else that's trying to buy urgently because they see inflation, they anticipate rates going up, they see how real estate, the shortage of inventory. So there's this urgency that is lighting this fire to get this offers extremely aggressive at this point.
Okay. This is going to be a hot topic, I think, tonight. We just had a question come in that says, how do you assess the recent inflationary surges to impact the overall real estate market? Will the buyer's demand decline? The interest rates have been increasing, yes, but not in sync with the high inflation we've been experiencing. So I don't know, Ron, do you want to speak to that, or Christia?
I think what you're going to see is one of the best things to be in when you have inflationary times is real estate. And so I think it's going to be the opposite. I think you're going to see even offers go higher. I think you could even see the appreciation go higher because people are getting into real estate, myself included, on properties that I own that are free and clear. I pulled capital out of those properties and I'm buying more real estate, okay, because I feel this inflation could last 2 to 3 years and it'll help offset whatever losses I'm getting as far as in the inflationary times. So I think it's actually going to be the opposite. And so instead of getting 10 offers, you know, if this continues any length of time, you could have 20 offers on that property, Chrissia, not 10. Okay, because people want to get in the real estate so they can fight inflation.
Right, and I think to your point, I also see, I concur with that. I have a lot of clients that are taking out whatever cash they have liquid because the inflation is only going to impact the value of your dollar, and they would rather have something that will hedge against inflation, like real estate, as opposed to having the money sitting in the bank. Again, it just really depends on the school of thought because there's a lot of different indicators that point to a possible recession, but that doesn't always go hand in hand with real estate. In the last 8 market recessions, only 2 of those have impacted real estate values. And those 2 were actually caused by the mortgage industry. So, you know, that's something else to consider.
I think what happens is people, 08 is still very fresh in everybody's mind, even though it's been several years ago. And we think, oh, if there's a recession or a correction in market's going to drop like they did in 08. And that's not true. Okay, they are not. Most times in the 30, 40 years I've been in this business, you know, that's the only time we ever had that major of a correction. That was self-inflicted by Congress, who allowed people to buy properties on stated income, which basically means you could lie about your income, you know, just to buy a house. And everybody jumped on the bandwagon, and that created that crash. In years before that, and decades, we might see a 5 or 6% adjustment downward, but nothing like we saw in 08. So I think we really need to look at what decades before us have happened, not what happened in 08, in 2008. So.
Great information. All right, let's go to Tyler and the Orange County market.
Hello. Yes. All right.
Happening in Orange County, Tyler.
You know, same song, different dance, if you want to say that. But what I want to talk about, because a lot of times, Christy and I get the question, and everyone kind of thinks about it, what is the best time of year in real estate, right? When should I buy? When should I sell? When's the best time? The summer's the best. Well, I wanted to share with everyone, kind of focus on the bottom grid there where it has the numbers. So number one month in terms of sales closed is actually May. And so what is that really telling us? Well, that is telling us that really the sales cycle, when people are starting and those closed or going into escrow and people really looking, is really the end of February till about mid-April to the end of April. Because cyclically, a real estate escrow will typically take 30 to 45 days. So when everyone thinks, well, I'm going to put my house on the market in July, right after the 4th of July, because that's the best time. Everyone's looking to move. Kids are out of school. It's after the big holiday. It's a yes and no answer. And as you see here, July is actually number 5 on the list in terms of best months in the real estate cycle. So just wanted to share that with everyone. You can see on the top grid how many homes were actually placed on the market. And this is a 3-year average. So just be cautious, because I get that question a lot of, well, and this even goes for the rental market as well. Well, I don't want to put my house up for rent in December because not a lot of people are looking. Well, at the same time, you have less competition as well. So you got to keep that in mind. When there's less demand, so to speak, there's also less competition, realistically. So just wanted to share that with everyone. And, if you have any questions, obviously contact Chrissy or I.
Awesome. Well, one thing's for sure, don't move near Christmas. All right. So we're going to jump into history repeating itself and basically combating inflation with real estate, which is kind of a great topic for what's happening in today's market. And I actually came across this article in the Realtor magazine that came to me in the month of January. And I had bookmarked it that I wanted to talk about this. And then it just so happens that it is on the forefront of everybody's mind today. So according to Lawrence Yen and the chief economist from NAR, is the National Association of Realtors, it says investors may look to the past to find that real estate is a good hedge against inflation. So exactly what we were talking about just a few moments ago. And then here's this chart talking about home prices compared to consumer pricing and how home prices continue to rise. And as we saw last year, and what Chrissy and Tyler both have mentioned, is that the home prices are going through the roof and increasing about 12%. Granted, this is through 2021 and inflation is like 7%, I think is what I read just today. So this is a little bit behind that, but home prices are still going up. And we'll talk about how rents play into that as well. So learning from history, in the 70s, consumer prices increased by 7.1%. Home prices went up by 9.9%. So interest rates were raised. Consumer prices in the 80s went up by another 5.6%. And home prices were 5.5%. And I also read, and I know Ron has talked about this, that the prime rate was through the roof during this time as well. So not what we're seeing today in terms of the interest rate, even with the minor increase that we saw come through today. And the home prices continued, or home sales continued, and rents continued to increase, similar to what we see today. And I will talk about that more in just a minute. From the 90s on, home price growth has matched or slightly outperformed inflation, which again is why it's a good idea to put your money into real estate. And if you recall, we talked previously in January about using your 401k as an option. And so if you actually have questions on that, reach out to us. Chrissy and Tyler definitely can help with that. So rents are accelerating. Rents have accelerated over the last 12 months by a gain of about 5%. And this is a national average. I'll tell you, in working with the leasing team, rents are going up astounding. We are being able to be aggressive 10% or more on properties that are below the market. And because of competition, it's still a good deal, if you will, for the renters in the properties. So we did some numbers, and I believe we had something like 3%, something, Ron, I can't remember the exact number, but it was really, really small, the number of renters that moved because we increased the rent. So increasing the rent is not, being afraid of a vacancy is not a reason to not increase the rent. Their analysts are saying, and part of this article I was reading, and is what we are also seeing, rents are going to continue to go upward year over year. Main reason, there is a housing shortage nationwide. Renters, people not buying real estate, people staying in place, those kinds of things. There's all kinds of things going on, but there is a housing shortage. So rents are going to continue to go up. The only thing that will cap that is a cap. And we do see that in certain areas in Southern California, LA being one of them. Tyler and I were on a meeting with our attorney, and he's like, first question out of his mouth was, do you manage in LA County? We said no. He said, okay, we can continue this conversation, because LA County marches to its own beat and has a lot more restrictions, including rent caps. There is a movement in the state of California to cap rents all the way around. So we're taking the position that if you can raise rents right now, we should be, because there may come a time in the very near future where they will govern the amount of increase that we can do. And data going along with that is showing that rental vacancies are at a 40-year low. In 2009, the vacancy rate nationally was 11%. In 2021, it was about 56%. I'm sorry, 5.6%. And I can tell you that our management one's rate is about 1%. I know I've mentioned this before. I've been with the company a long time. I have never, in the history of working for Management One, never had properties for rent. And there have been moments in 2021 where we had no properties because people aren't moving. Working from home, working remote has brought about a different hurdle in property management, because people can work from home. They don't need to relocate for their jobs, or they can relocate for their jobs because they can go live somewhere else. So you kind of have this tug of war with vacancies, and we certainly have seen that for us. So what is in it for you as an investor, whether you currently have properties or you're looking for a property? This is a great time to grow your wealth through real estate. We've talked about, even though the prices are on the rise, interest rates are low in comparison. When I created this slide, we hadn't had the vote. And of course, we know that the interest rate went up a little bit. I did read that they're projected to raise it 7 times between 2022 and 2023. Small increments, 7 times over the next 18 to 24 months. It's still low compared to the 80s when it was 18%. So if you can, now's the time to call Christia or Tyler. We just mentioned this, but we can't tell landlords enough. Now's the time to increase rental properties, rents on your rental property, because again, they will pass legislation at some point in time. If history repeats itself, Orange County and Riverside County will end up with rent caps. We don't have a magic crystal ball to tell us it'll be next year or 5 years from now, but it's going to follow suit. They will make affordable housing a thing. And you can bet that in the short future, rents will be capped. So you might as well take this opportunity to start bringing your properties up to par in terms of that. We just ran comps on some properties, Ron, and he's like, Kristen, these are so low. Yeah, there's some of our properties that are still renting for $1,200 and $1,300. At today's value, they could be pushing close to $2,000. That's a huge loss. $800 a month times 12 months. That's a huge loss at the end of the year. And let me just say this, you're not greedy to increase the rent. You have to think about rental as a business, and you have to make that mind shift. You're not just a landlord, you are running a business. The government allows you to take those tax deductions because they consider it a business. So you should have that mindset as well. Because here's the thing, right? Who had to go buy a dishwasher lately, or garbage disposal, or any appliance? They're expensive, way more expensive than they were 6 months ago or 12 months ago. That comes out of your bottom line. So by increasing your rent according to market value allows you to recoup some of those costs. And gas alone is up 56%. I drive a minivan and it was very expensive to fill it up, and I don't have a truck. So, you know, it's there. The pain is there. I will answer that question in just a second here. Repair costs are going up, as I just mentioned. Property taxes are increasing. And you know what? Your property is going to need a new roof. If you've had it for 10 years or more, that roof's going to be coming, especially if you bought the house and it was already aged. You're going to have a vacancy. You'll need paint. You'll need carpet. All of these things are going to come. And then you're going to wonder, how am I going to pay for these things? If you incrementally increase according to the law, then you will have money in your piggy bank, as Ron calls it, for those repairs when the time comes. I think this is going to answer your question here. So current laws in California allow the following, and Tyler and I just like 2 weeks ago met with our attorney to make sure that we were on track with this. So if your property is owned under a corporation, it can only be increased by 5%, that's your base, plus the local CPI. Right now, and I just confirmed today, right now, the local CPI is 3.6% for Riverside County and Orange County. So that's a total of 8.6% is what you can increase your rent if you're owned by a corporation. If you own it outright, and it's a single family home or a townhome, you are not subject to rent control. So you can increase it by 10% with a 30-day notice. Typically at Management One, we do give a 30-day notice. At least we try to give 45 days notice to a resident that the rent is going to go up. So you can do that by 10%. If you have a duplex or a triplex, you automatically fall under AB 1482, and the max you can increase is 10%. Single family homes can actually be increased more than 10%. So if you have a property that is that $800 under market, we can serve a 90-day notice to the resident and increase your rent to swiftly bring it up to market. You probably cause a vacancy because, you know, $800 is a big hit to somebody who's used to paying $1,200. As I mentioned in previous webinars, a month and a half ago or 2 months ago, we talked about using your 401k. Now is the time to take action. Inflation is here. They anticipate it at minimum to the end of this year. As Ron said, it could go another 3 years or more. Home prices are going to continue to rise. Interest rates are still low. They've already told us effective today, they're going to go up. And rents are on the rise, and they're going to continue to rise. So now, if you can, is a time to take advantage of this storm that we're all in. So that's the end of my presentation. Do we have any questions? Or Ron, do you want to add to?
Well, I think I want to put the emphasis on raising your rent. And all of you know, I own several rental properties myself, and I have for years, and I'm still buying today. But the thing of it is you are going to have to replace roofs. you're talking sometimes 15, 20,000, depending on the size of your property. You've got HVAC, air conditioning, heating units got to be replaced, and then of course, all the carpeting and the painting. And it isn't your responsibility to take your money out of your personal savings away from you and your family to fix your rental property. Your rental property needs to take care of itself. But there's two things that has to happen to do that. Number one, you've got to raise the rents consistently. Okay. Now this has been kind of a runaway train here with this COVID-19. Okay. But in just normal markets, we want to raise it, gradually. For an example, you take gasoline, right? If gas goes from $3.50 a gallon to $3.70 a gallon, it's not a big deal. But now that it went from $3.50 to $5.50, okay, or in some parts of California, $7 a gallon in LA, it's like sticker shock, right? It's like, what's going on here? Okay, and you don't want that to happen. But residents, as we've talked before, will move 7 times faster because you do not improve that property or take care of maintenance timely than they will if you raise their rent, gradually. They expect that, but they also expect the service, okay, is on it. So that's number one. Number two, and we've talked about this before, but very important, ladies and gentlemen, you need to open up a separate checking investment account where that rental money goes into that account. Because like on that one, if we raise your rent $300, you get $300 more in your personal checking account. It's just going to be squandered away innocently, but it's still going to be away. So when we call you for a $10,000 roof, it's not going to be there. So tomorrow morning, make sure you open up a checking investment account, and make sure all the money that we send you that you put back in that account. Otherwise, the roofs are coming, the HVACs are coming. I don't know when, but they're coming. How do I know that? Because they happen to my properties. Okay. I don't get any special treatment here because I own management one. I get hit just like the rest of you. So, if there's anything I can plead with the audience tonight is to do those two things. If you do, you're going to be a happy camper. Okay. So
I would say another thing too, before we move forward is, like Kristen said, that fear of, well, if I raise my rent with my current resident, then they're going to move out and then I'm going to have a vacancy and I don't want that. Well, in today's market, we're seeing that we sometimes rent properties within 4 hours of putting them on the market. And the rents are even more so than they would be to the current renter. Mm-hmm. So that's another thing to consider. A lot of times I get, well, I haven't raised my rents in 5 years. And especially within these past 24 months, it's astonishing. And then, some people on this call might be doing it as well, but managing your property on your own, which is fine. But then they want to ask about our management costs. And I say, well, if you look at it this way, if your rent is at $1,300 now and the market is at $2,500, if you come to us and we raise your rent to $2,500, our management cost is free. Mm-hmm. And now you have the protection, you have the professional. We're raising rents each and every year, depending on the market. So there's a lot of advantages to doing that. And the consensus is basically, don't be scared to raise your rents, whether you manage your property on your own or we do or another company. Just don't be scared to raise those rents.
Right.
Well, the other thing of it is, ladies and gentlemen, when you do a rehab on a property of $10,000, between federal and state taxes in California, you're getting 40% of that back. Okay, so it's really costing you 60% or $6,000 to rehab your property. Okay, and the other thing of it is, like Tyler, on the management fee to manage your property, if you're managing your own property today, is if your rent's 13, it should be 25. Your management fee is $1,200 a month, because that's money you could be getting. Okay. Yep. And so you just got to look at that as a management company. And most of you out there manage your own properties. 95% of people across the country raise their rents every 5 years, and normally they'll raise it like $50 or $75. Okay. That's known in the industry, because we're in this myth that people stay because they don't raise the rent. And it's absolutely 180 degrees the other way. Okay, and we've proven it in 37 years of management, one in thousands upon thousands of properties. So it isn't like we're a company that started a year ago and giving you this information. What we're sharing with you here tonight, you can take it to the bank. Okay, so
let me just put in very quickly the resale value. Okay, let's talk about that, because I have quite a few properties that we have sold where the owners will express that they want to sell those properties as is for an investor to take over. Going in and oh, look, we have a guest. Going in and you know, putting those that rehab is an opportunity. It's an opportunity to bring your property up to date, to look at anything that will cost you a lot more money, like termites, roof, things along those lines along the way. In addition to that, we get a much higher rental rate for a property that has been fixed up than for a property that hasn't. But when I resell these houses that are actually move-in ready, that feel good, that look pretty, those are the houses that we're selling at $50,000 above asking. The ones that we're selling as is, we're selling to investors. And most of you are getting flyers from investors saying, I will buy your property cash now, no need to use a realtor. But they're offering you 80 cents to the dollar. In this market, you shouldn't have to take a cut of 80 cents to the dollar. You know, by investing those 25,000, say, on a real nice rehab with stainless steel appliances, brand new kitchen, all the perks, you're actually going to get that back. So in more ways than one, in the rental and in the resale value. That is, if you want to capture top dollar with the first-time home buyer, owner occupied buyer that's actually looking. And if you don't want to do that, then yes, but investors, you know, it's a business. So it's about numbers and making them pencil out. As an agent, if I'm going to represent you, I'm going to say, hey, if you want to put it on the market and get top dollar, I suggest that we fix it so that you have all the options, right? And that you're able to capitalize on what you put into your house. So, yeah. So,
Christia, on that, let's just so I understand it. So basically, if somebody invests $25,000, okay, you can get them $50,000 more in price. So not only do they get their 25 back, but they made another 25,000.
Not only that, those houses that we are rehabbing, like the last 4 that I put in escrow, we did full rehabs on those. They sold within 3 days. Where we have neighborhood houses, in this market, nothing's really staying, so I'm not going to use that as leverage, but they're sitting on the market 3 months. They're coming, or I'm sorry, 2 weeks, but they're falling out of escrow sometimes. They're having to do repairs through escrow. Now the property's tied up, and you know, every day that your house is sitting there vacant is a day that you're losing of income. Yeah. So in this case, it does give us the upper hand to go in the market, sell right away, get top dollar for our clients. And, you know, I mean, it almost seems like common sense, but really when you look at the numbers, it makes a big difference in the way that it translates to the consumer.
Yeah. Unbelievable. Unbelievable good. Okay.
Okay, I think we will move to Ron.
Okay. Well, this is a very interesting subject, ladies and gentlemen. We are not going to get in what we call in the weeds, because this thing goes very, very deep. The purpose of tonight to show you the vehicle that you need to use here, that the federal government and the states have given us, you know, to go ahead and keep and generate even more wealth. So that's the purpose here. You'll see on the screen there, you know, federal capital gains 20%, and in California it could be another 13.3 depending on what you know, tax bracket that you're in. Okay, so let's go ahead and get started here, and go ahead. There we go. Okay, so on the 1031s, there's 4 types of exchanges here. Okay, so let's go over the first ones here. One is a simultaneous exchange. This is when the property you're selling and the property that you're buying closes on the same day. That hardly ever happens, okay, but it is possible, and that's why they have it that way. Okay, next one is a delayed exchange. This is the most common. It's when you close escrow on your property that you're selling, but you've not identified the property that you're buying yet. Okay, And what you do on that is you have 45 days from the date your property that you're selling closes escrow to identify the property you're buying. And then you must close 135 days after that for a total of 180 days from the date your property that you sold closed escrow. Okay, if you go past that 180 days, you trigger capital gain, even if it's only 1 day. It doesn't matter with IRS, okay? Next one is reverse exchange, just kind of opposite. It's similar to the delayed. However, it's when you acquire your replacement property before you have sold your current property. Same rules apply. The 45 days, the 135, and the 180 days, it all comes together, just in reverse, okay? And then the last one here is an improvement exchange. This is where you can do improvements that allows you to make it on the replacement property prior to the final acquisition. I've actually done this, okay, on one of my properties, in fact, several times. So those are the 4 types of 1031s that you can actually, use. Now, same 45 to 180 days on that as well. But our focus tonight is going to be mainly on the delayed exchange. That's what most people use. And what you're going to need to have what I call a successful, non-stressful exchange. Okay. It's very important that you have all your ducks in line before you start putting your house on the market, and selling it. Okay. You're going to need a CPA. You're going to need a qualified intermediary. That's kind of like a facilitator. I normally use First American Title because they've been around for 30, 40 years. And a lot of questions that we get is, how do I know my money's going to be there? Well, if you go with a quality company, you're going to go ahead and be able to do that. Okay. Next is on the, my screen, like, okay, real estate broker. Okay. Tyler and Chrisia, they're very familiar with the exchanges. And they can also put you in touch with the other people that you're going to need to have. Sometimes you'll need a financial advisor, depending on how complex, it is with your portfolio. Okay. And then also a real estate attorney in some cases as well. Just depends on how detailed it is. If you're moving a lot of properties around, then we're going to need more people involved as far as to take care of this. The good thing about it is your real estate agent or broker, you're only paying them if you're selling a property on the commission, but you don't pay them any extra. So they can organize all this for you. Okay. And for an example, the house that you're looking at buying, they're going to have you pre-qualified. I mean, fully qualified, not just a pre-qual letter, but fully qualified. Know you can buy that house you're looking at before we ever put the house on the market to sell it. Okay. We want that all done. Okay. So there's no, chances that you would knock yourself out of the exchange. Okay, what is needed for 1031? Your replacement property needs to be equal or greater than the value of the property that you're selling. Okay, you got to identify it within 45 days. And I know some of this we're repeating, but it's worth repeating, okay, because it sometimes takes a while to get accustomed to it. And then you must conclude it within 180 days. So that's what you need as far as for the 1031. Now, why do a 1031 exchange? Everybody says, oh, that's too complicated. Well, when I'm done here, you'll probably think that maybe it's not that complicated because of the money that you're going to save. Number one, you can avoid the 20% capital gains on the federal and some state taxes. Like California, you have, state taxes. Florida, there's no state tax. Nevada, there's no state tax. Okay. If there is in Texas, there's no state tax. So there's a lot of places, that don't have state tax. There's actually 10 states in the United States where you have no state tax. Okay. Second reason is you can also avoid recapture and depreciation. And I don't want to get too complicated here, but when you have a rental property, your CPA or accountant depreciates that property. That's why you're able to have some tax savings of $2,000 to $3,000 a year. Okay. When you go to sell that property, you have to recapture that. Okay. So not only do you have the gain of what you bought it for to what it went up, but you also have to recapture some of that depreciation. The other thing of it is this is an example, okay? So what I did is I took a property I bought in 1977 when I was 12 years old for a little over $100,000, okay? Okay, just joking there. Okay, so 100,000, okay? And I made these numbers simple so we could navigate and understand this more easily. Today, it would sell for over 800,000, probably a little bit more, okay? So that means I'd have a $700,000 gain. So just on federal taxes alone, I'd owe $140,000, okay? Okay, then if we go to California tax, unfortunately, I'm in the highest bracket, so I'd pay another 93 grand, okay, as far as in state tax. So if we add those two together, that's a total of $233,000 it's going to cost you, or in this case, me, unfortunately, if I did an outright sale. So you can see it is significant, okay? But there's more to it than just this. Not only are you going to give the 233 back to the government, which I'd like to ask everybody on the call tonight, who can manage your money best, the government or you? And I think I know the answer to that question, right? Okay, or your kids. If you don't do it for you, then do it for your kids or your kids' kids.
Mm-hmm.
Okay, and you're going to see what I'm talking about right here, because we talk a lot about generational wealth today. Okay, so let me go to the next line here. Here's the second leg of why to do an exchange. Okay, you got to 233. So now the fact that you didn't pay that money to the government, what could you do with that? And I'll ask Tyler and Chrissy, could we buy a $700,000 home and put $233,000 down?
Absolutely.
Yeah. Okay. All right. So now, instead of giving this 233 back, now we took the 233,000, put it down on a $700,000 house. So now we leveraged that 233 at 700,000. And if the appreciation rate is 20%, we're going to make 140 grand a year on that new $700,000 purchase on money you would have never had. And you're going to make that, even if you only make 10% a year, that's 70,000 a year. And that's not uncommon in California. And we all know that.
Mm-hmm.
So I hope you're all with me. This is the second leg of why you do an exchange. Okay. The next thing of it is you can build your wealth faster when you do these 1031 exchanges. Okay. Some people say, well, I'm 50 years old and I don't have the time that I would have if I'd have started in my 20s. To be honest with you, ladies and gentlemen, if you use some of the vehicles that's available to us in investing, you can pick up years. Okay, because how long would it take you to save 233,000? First of all, you're going to have to make more than 233,000, because if you're in a 30% federal and 10% state, that's 40% they're going to take out of your paycheck. So in order to get that, you're going to have to make 400,000 or 500,000 even to put 233 in the bank after taxes. So that's what we got to look at. How hard is it to get that back into my bank account? The next thing of it is, and you can leave more money for your kids than the government would have gotten. And the thing of it is, one of the biggest, things I think we could give our children is not only just give them money. That doesn't do a lot. But if you give them money and knowledge, look what they can do with it. Because if you're doing this, then you will hand it down and say, look, if we go ahead and you do a sale of a property, you have to consider a 1031 first. Okay. All right. So the last thing of it is like I say, increase generational wealth for your kids and their kids. And it just keeps going on. So if you look at this over a 40, 50, 80-year period of time, you're talking not hundreds of thousands, you're talking about millions of dollars, that you can create in your legacy for your kids and your kids' kids, and along the way, you can go ahead and enjoy it as well. Okay, so some questions that we get on 1031 exchanges, okay, is can I live in my 1031 exchange property? And the answer is yes. If a property is being acquired through a 1031 exchange, it is later converted into primary residence, as you see on the screen there, you must hold it for at least, no less than 5 years, okay? For otherwise the sale is going to be fully taxable. So, and again, I caution this a little bit of making an exchange property when you're living in, because it does raise red flags. Okay, so we recommend that you keep it arm's length, and everybody will tell you that does any kind of exchanges in the world. Okay, what's the cost of an exchange? Okay, basically the accommodator, your facilitator, your intermediary, there's several names they call these people or these companies, about $1,000, but they make interest on your money until it goes into the property you're buying. Okay, and so with that, you know, they're making a little bit of extra cash as far as on theirs as well. Okay, can you do an exchange with a family member? The answer is yes. However, this is a major red flag with the IRS. Okay, my recommendation is don't do it. There's special rules, you know, that you got to be followed, and it just creates a lot of red flags. And why put yourself through it? Now the question is, can I sell one property and buy 3 more? The answer is yes, as long as you meet the requirements of the exchange. Okay, you've got certain dollar amounts, certain monies have to go in, you know, and the values and everything. And this is a much too short of a webinar to get in to the details and into the weeds, as I call it. But we're more than happy to have this conversation with you, and Chrissy and Tyler would be more than happy to have a phone call as far as with you, as far as on that. Okay, another question is, can I sell a single family home and buy a fourplex? Okay, the answer is yes, because it's considered a like for like exchange. What does that mean? It means that income property has to be another income property, but it doesn't have to be a single family for single family. Okay, it can be a single family for a duplex, a fourplex. You can commercial, you know, or you can go from commercial back to single family. You can do that as well. Okay, so don't get hung up on it. It's like for like means single family for single family. No, it's income producing property for income producing property. Okay, that's what they mean like for like. Okay, now, so what we're going to talk about is an actual case on one of my properties that I had. It was the office industrial complex I had for 30 years. Okay, on that. And basically, I bought the property for about $580,000. Okay, and then sold it as far as for $2.5 million. But it's actually more than that, because over those years, it paid itself off, and we brought in about another $2.5 million in cash. So basically, on an investment of 580, it brought in about $5 million over a 30-year period. Okay, so when I sold this, you know, it was stipulated in the listing that it would be involved in a 1031 exchange. Okay, and that's important that that information is in there when you go ahead and sell the property, you know, that you're going to be selling in the exchange. Okay, so one thing I did, I purchased a commercial building. It's much like a Walgreens you would see would be in it, and then they would lease from me, you know, and what we call a triple net lease. So that's one. So you can see here, I went from an office industrial into a commercial. Okay, and then I bought 2 new single family homes, you know, all cash as far as with this. And so that completed the exchange. Now, the reason, as I said earlier, you want to make sure you're working with somebody that's very competent, knows what they're doing, so you don't have any slip ups. Okay, because by doing this, instead of selling outright, I saved $500,000 in capital gains tax. Okay, $500,000. Okay, and now I was able to go into more investments. Okay, because I didn't just go and give that money back as far as, you know, to the government. So now people say, well, when does this ever end? How about when do I get to cash out? Well, basically, and I'm going to use myself as an example. Basically, you know, I don't plan on cashing out. What I will do is keep buying properties, leveraging them out. But if I want to pull, let's say I want to do something in my life personally, and I want to pull out $100,000 to do that, I can go ahead and take a mortgage on this, pull the money out, and with the extra cash flow I'm getting because we're raising rents, it would make the payment on that $100,000, and I'm not taxed on the $100,000 either. Okay, if you do an exchange or you pull money out, you don't get taxed. You get taxed when you sell. That's what triggers the capital gains. Okay, and so another step on this is with your children. Okay, basically this is how it works. So somebody doesn't have to pay the gain. So let me give you an example. So if I sold this property a day before I pass away, and I don't plan on doing that anytime soon, Tyler, okay? But if I would do that, I could end up maybe $1 million that I would owe in capital gains tax, okay? But instead of doing that, I don't sell, I pass away tomorrow, and the day after that, Tyler sells it, okay? Now that'd be a little quick, Tyler, so you might want to wait a couple days. Okay, but okay, maybe after the funeral. Okay,
maybe.
But what I'm saying here is if he sells it, what happens with this, Tyler and your siblings too, we get a stepped up basis. What that means is that $1 million that I would have paid if I sold it the day before I die, if Tyler sells it the day after I die, he pays no gain.
Right.
It wipes out all that gain. Okay, so now Tyler can go ahead and he can use it to whatever, buy whatever he wants to buy more real estate if he wants to sell. Okay, so I recommend this though. Once, I'm saying we, like all of us, except the children, okay? But once you pass away, I do recommend that the siblings make sure that they get an appraisal on every single piece of real estate that you have within 90, no more than 180 days. Because here's what happens. Let's say Tyler doesn't sell, okay? And 10 years from now, he decides to sell it, okay? And now it's worth, let's say, $4 million. But IRS comes in and says, no. It wasn't worth $2.5 million. It was only worth 1.5. So now they're going to tax Tyler, another $1.5 million, okay? Compared to if he had had a bona fide appraisal done, it would have protected him. Okay. Now you might spend $1,000 for every appraisal, or sometimes on a commercial property, $4,000 or $5,000. But let me tell you, it's the best money your kids can ever, spend to make sure they don't get hit with major taxes as far as down the road. So really, really important from that standpoint. Okay. And here, of course, we have all the resources. We literally can save people hundreds of thousands in capital gains, and you can create your own wealth, okay, by doing this. So the beauty with us here with Management One, with Chrissy and Tyler, and all the resources we have, put together, really just a matter of setting down, making sure we have all our ducks in line with you, and then we go ahead and put the properties on the market. And everybody's going to be a little bit different. People say, well, can I pull some money out in the exchange? You can, but it's considered what we call boot, like a boot, B-O-O-T, okay? It's a little acronym they have that, but it's boot, but you would have to pay tax. So it gets a little tricky in there, but it is possible, and your combinator, they would go ahead and work with you as far as on that. They'll let you know what you can and cannot do as far as on that end of it, along with your real estate attorney. So with that said, we'll open it up for a few questions here.
We do have some. Ron, can you do a 1031 exchange if you have a trust or an LLC?
Mm-hmm. Yeah, you can do it. I mean, it's a real estate is real estate. How it's held in title is not the situation there.
Okay. And then another question we have is, what is the benefit of doing a 1031 exchange? Why not just keep the property you have and then buy more?
You can, but there may be certain times that, in your life that, maybe you're moving away from that area and you want to sell it, or maybe the area, in my case, I felt the area itself was losing, some value on where I had my office industrial. After I had it for so many years, I didn't like the way the city was going, the neighborhood was going, and it was an opportune time. And I sold it right at the peak there and was able to move that capital into another investment. But you can do either or. But those are a couple of the reasons that you would want to do, a 1031 exchange. Okay.
Okay. That's all the questions we have coming through, and we are just about out of time, and we want to respect the evening. So, Tyler? we will not forget about you. Take
Yeah.
it away with the market update.
I got 2.5, 3 minutes, so I'll make it quick. But there are some important things. So there's about 3 in terms of new legislation. So this first one, it's not set in stone yet, but basically there's a bill that's going to be heard, as you see there, on next Thursday, the 24th, as far as helping landlords with rental assistance with residents who either didn't cooperate with them or if their resident didn't qualify for it. So that is huge, because if you are a landlord and those 2 things, one of those 2 things happened to you, which is your resident didn't cooperate with the rental assistance because they didn't want to pay rent during the pandemic, or they just flat out didn't qualify, this bill, if it does pass, would actually allow, under certain circumstances, for you as the owner to get paid that back rent that's owed to you. So that will be huge. Again, we'll have more updates and definitely be keeping in touch with all of our owners and everyone on the call here tonight when that passes. And then the next one is very interesting. It's basically a bill that was almost there, and thankfully for you as landlords and owners of properties, did not pass. And that was that the lawmakers were essentially saying that when you're qualifying the resident, whether it's you're qualifying them on your own as a landlord, or you use a management company like us, whatever the case may be, that you could not use credit reports as a qualification standard. Now, some people might think, well, that's not a big deal. In our experience, again, because we don't just check the credit scores, we're actually going very deep on those, is that would have been huge. So again, that did not pass. That's a good thing. And then the last one is the Rental Registry. And basically what it's saying is the bill, it would require owners to essentially submit a form each year to the State Department of Housing. The form, it does require a variety of data, number of evictions, the reason for the evictions, days the property was vacant, etc. So if you have questions on these, reach out to us, reach out to me, and we can absolutely, get you more info on those as well. And we're just at the top of the hour. So with that, if anyone else doesn't have anything, I'll let Kristen end us here for the evening.
Yes. So we actually will be back here May 18th. Ron, what is our topic for May?
Well, I got a surprise for you guys.
Okay.
Okay. Yeah, it's going to be really on. You don't want to miss it. Okay. And just in closing out here tonight, ladies and gentlemen, we appreciate your time. Please contact us. If it's no more than just a phone call, you can reach us on the numbers on the screen there, or email us, but do consider raising those rents, and make sure, if you are going to pull out any capital on your on a property, whether it be your own personal property or another rental property like I'm doing, and buy more real estate, probably want to do that sooner or later, so you have a little bit lower interest rate. To me, interest rates 2, 3, 4, 5, 6, it's really not a major deal. If you've lived through the times I have at 17, 18%, and the average was 12, 13, these are good times. So we'll let you go from here, and appreciate Kristen, Chrissia, Tyler. Thanks for joining. Okay.
Bye.
And we'll see you guys in 60 days. Have a good night.
Bye.
Bye.